I'm Larry Ray, President and CEO of American Manganese, Inc., listed on the TSX Venture, ticker symbol AMY, A-M-Y, with proprietary patents in the U.S., China, and South Africa. Our focus is on recycling lithium-ion batteries for electric vehicles. China recently legislated the responsibility for recycling onto their electric vehicle manufacturers and importers. For more information, please visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is Rick Ackerman, editor of the newsletter Rick's Picks. His website is rickackerman.com. He's speaking to us from Superior, Colorado. Welcome to the show, Rick.
Thanks for having me on, Jim.
We're in one of the most interesting equity markets ever. We had that giant drop to start off the year, and now things are almost back to where they were. What's happening there?
It's surreal. We've got the market within spitting distance of record highs, yet we've just come through a quarterly earnings reports that were disastrous. Corporate earnings are off something like 15%, and we've got the market trading at a multiple of something like 24. It's amazing, and you can see really that the effect of all this funny money just supersedes any concerns about the real economy, the real world, and we're at the point now where even though the central bank is not buying stocks directly, as is happening in Japan, the effect in the U.S. is indirect. When you make money available to borrow for almost nothing, you see that everybody uses it for purposes of speculating in the stock market. So, and that includes the companies themselves. They have the incentive of borrowing money for next to nothing, while they're sitting on huge cash reserves, by the way. They go out and borrow more simply because they can. They buy up their own shares, and it has the effect of shrinking the float, which pushes your earnings per share higher. So we're creating artificial earnings, and you just kind of wonder when it's going to all end.
Wasn't the idea of low interest rates to have businesses expand and hire more people?
Yeah, and no business wants to do that. They're all sort of looking out to the future, and they see the same thing that we do. Why would you want to expand in a big way with things so uncertain? One of the unanticipated effects of all these of low interest rates is that, or with the Fed tampering with interest rates, is that it creates uncertainty as to the monetary climate, and it makes these companies less inclined to invest.
Yes, I've noticed whenever a company has a massive layoff, their stock goes up the next day.
Yeah, there's always some perversity there, and it's on the earnings side too. A company will come in with great earnings and the stock will get pounded. You get the idea that it's not reality that drives these stocks up and down. It's just mysterious forces.
Now, I know it's not illegal, but should companies be banned from buying their own shares because of what it does to the stock market?
Well, that'd be very un-American. I think that they can choose to do, they should have the leeway to do whatever they want to do, but there should be some pushback from shareholders. Well, the shareholders aren't pushing back. They see the stock go up and up and up, and they're not going to question the reasons, such as companies shrinking their shares in order to drive the earnings multiple. So if there's a constituency for sanity, it's being really muffled by just the upward march of stock prices.
I saw that what's happening right now, brick and mortar retailers are getting hit hard, whereas companies that have online shopping like Amazon are awash in cash. In fact, Amazon was saying they don't know what to do with the money. Well, they could ship it to you and me, I guess, Rick.
Well, the frightening thing about the deterioration of brick and mortar retail is the rate at which it's accelerating. You know, a lot of the best and brightest retailers, Macy's, Nordstrom's, Target, Kohl's, they all were anticipating a weak Christmas period revenues, but the decline in revenues was much steeper than they'd expected. And, the shrinkage is happening much more rapidly than you might have imagined even 3 or 4 years ago. So when companies like Macy's are scratching their heads and wondering what the heck can we do, there doesn't really seem to be an answer. And you can see that the big box stores here, right by where I live, they closed a Best Buy right at the Christmas season. They packed it in before December, and there'll never be tenants for these stores, so that creates a problem in the future that would, I guess, be in the category of creative destruction. They'll all have to be literally destroyed, torn down, and who knows what will go in their place. But for one of these days, I guess we're all going to buy everything from Amazon.
And it will be delivered by a drone if they have their way.
Yeah, that's coming probably sooner to Canada than to the U.S. But and apparently in Europe they've taken to drones more enthusiastically and with fewer regulations than here. But anyway, it's some of the survivors, such as Macy's. The idea was that it's nice to go to a department store and feel that cashmere sweater that you want to buy. But I think just for the price breaks you get, buying it on the internet, people will say, well, I'll just trust the fact that this is a 3-ply cashmere and it's nice and soft, and I'll buy it sight unseen. So, and some of these guys, Nordstrom's is doing everything right. Best Buy did everything right, and they're still dying. Best Buy got serious a few years ago. They recognized the challenge of online competition, and they did all kinds of smart things. They put better, more experienced people on the sales floor. They worked deals with some of their vendors to share in the costs of in-store display and things like that. And most crucially, they got serious about a price match. You come in here with an online price, and we'll tie it or beat it. So they couldn't have done more, really, to go at the problem, and yet they are slowly wasting away, or I should say quickly wasting away.
Well, one of the advantages shopping malls always had over downtown areas was free parking. The city of Vancouver has been very successful in its war against the automobile. They've upped parking fees. In fact, 28,000 fewer cars go into Vancouver. And I've also noticed a lot of businesses with closed signs on the door. They're losing customers because there's nowhere to park. And all the driving lanes have been replaced by bicycle lanes. So even if you did buy something big, you have nothing to load it onto.
Yeah, and there's a lot of incentives coming from the federal government to drive this increase in density. California is reconfiguring itself in that way. The idea is we'll have one megalopolis from San Francisco to L.A., and that people will not have to, that everybody will be able to walk to his job, but that doesn't take into account what the jobs that they'll be walking to. There won't be any jobs, and the urban density for the sake of saving on transportation costs, I think, is a flawed model.
Well, in Vancouver, because of the super high price of real estate, you can't have young people looking for, those startup jobs because I can't afford to live there.
That's a big problem, and it doesn't, even in a small town like Boulder. Boulder has a thriving high-tech economy, and it's getting to be the go-to place for California companies that are just seeing costs of housing, of space, and of finding workers go through the roof. So we've got Google here, major expansion. They took 2 giant office buildings and they kind of outgrew them in about a year, and now they're building I think it's a 550,000 square foot campus, and that will generate enormous. I don't know how they'll handle the traffic, much less the housing requirements of all the high-paid tech workers that'll be there. But Boulder has fallen into line with this high-density idea, but it seems to me to be just for its own sake. It hasn't been thought through economically.
Well, the U.S. wholesale trade was higher than expected in March. Is that because the online people are doing well?
Well, yeah, the wholesalers are going to sell into any channel that exists. So if the brick and mortar side of it dies, they're still selling to Amazon and all the vendors who sell through Amazon. So the wholesale business, I'm sure, will be fine as long as the consumer economy holds up.
Now, of course, over the last 10 years, real wage growth has been 0 or less, and the inflation numbers that we get from the government are totally skewed because they don't include housing and energy prices.
Yeah, that's kind of a peculiar oversight, or I guess it's not an oversight at all. It's just kind of manipulating the numbers. But that also goes to something that I've written about, that what we think of as inflation is really deflationary. And by that I mean that if you have no wage growth and consumption is still increasing, it means that that can only happen if people are borrowing in order to consume. And of course that happens on a very large scale in the all important automobile business. We've got great, we've had banner years for car sales, but if you look at the macro picture, incomes haven't increased and people are buying more and more cars and more expensive ones. It simply means that they're more hocked in order to get those cars. And the leasing business, I think something like 30% plus of all cars are leased. And what that says is that, the beauty of the lease system is that it allows you to own more car than you can really afford. So all of this piles up, the debt that's required to keep consumption on an upward incline at a time when real income growth is stagnant. It just means we're borrowing. And of course, the down the road consequences of borrowing is deflationary.
Well, they said interest rates being very low will encourage consumerism, but the credit cards never lowered their rates. They're still charging 19-20%.
I'm frightened to think of how many people are actually buying and paying those interest rates. I'm in the habit of paying off my household charge card each month, but when you look at the returns on investment that you get from pretty much anything these days, you get paltry yields and all kinds of fixed income vehicles. You can see why the lenders want to expand, for one, mortgages, but, retail or, consumerism as well, because even with, 5%, loss rate on that, people run up credit card bills and they don't pay them at all. Even if the lenders get stiffed for 5 or 8%, the overall returns are still better than you can get in any other investable asset. Just the stream of payments from consumers who do pay their monthly charge cards, or the ones that don't generate interest charges, is the stream of payments winds up being securitized, and they're some of the best returns you're going to find.
We'll have more with Rick Ackerman right after the break.
I'm Larry Ray, President and CEO of American Manganese, Inc., listed on the TSX Venture, ticker symbol AMY, AMY, with proprietary patents in the U.S., China, and South Africa. Our focus is on recycling lithium-ion batteries for electric vehicles. China recently legislated the responsibility for recycling onto their electric vehicle manufacturers and importers. For more information, please visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
Welcome back. We're speaking with Rick Ackerman. Before the break, we were talking about consumers, spending money that they don't have with all these loans. Well, now in Canada, they've just announced that MasterCard, Apple Pay in Canada will involve 4 major banks where you just have to swipe your phone instead of using the card. I'm wondering about security concerns if your phone gets stolen, because stolen phones are a hot item.
Well, the technology there is, I think we're probably already there, where you get a fingerprint match anytime a charge is made, and I do think that that's one area where the banks are improving their margins. They're getting better at fraud detection in the use of credit cards, and of course that's where the money is. They're just making it as easy as possible for people to spend without thinking they're spending. And from the bank side, the only thing they have to do is make sure that they don't get defrauded or defaulted on too much of the time.
What's your outlook on oil prices right now?
I think it's really capped at $50 a share, $50 a barrel. I see a range between 50 and 20, and the stock market and the banksters are all kind of rooting for inflation in the oil patch, simply because so much lending has been collateralized by energy resources. So, but the case for higher prices, and by that I mean significantly above $50 a barrel, is really constrained by forces of supply and demand. And some of these oil bulls must think that you can suppress supply sufficiently to keep oil prices buoyant at a time when demand is falling. Certainly the biggest buyer at the margin, China, is demanding less oil, and when that happens, it seems like it's a very difficult, if not impossible, proposition to get crude prices up. So supply and demand factors are working against higher crude prices, and at the margin, just a little bit of shrinkage in China goes a long way to push prices down. So I think we're sort of capped at $50, barring some terrorist episode where a oil tanker in the Strait of Hormuz gets taken out by a Stinger missile or something. So the bounce from a low, this would be basis NYMEX contracts, a low just under $30, 29 and something, up to a recent high of about 47. It's a dead cat bounce. So I think we've gone about as far as we can go.
The forest fire that hit Fort McMurray and forced the evacuation of 88,000 people has cut oil production there by 1 million barrels a day. The oil facilities themselves weren't hit by the fire, but all the people who worked there had to run away.
And you've had a rally in crude as a result, but you can see that it's not having quite the effect that it might have had 6 months ago. The oil, the price fluctuations are cyclical, of course, like everything, and it just so happens that the Alberta fire and the resulting curtailment of supply is occurring at a time when the rally in crude oil prices has just about reached its upper limit.
And of course, Iran is almost back to its pre-sanction production. It's at 3.5 million barrels a day, and they plan to ramp it up to 4. And Venezuela is under the same pressure. They've got to pump like crazy, and even the Saudis do. The Saudis had a really bloated, let's say, civil, or their equivalent of a civil service economy, and their expenses have been high. So whenever I read stories about Russia and China getting together, or Brazil or Venezuela and Russia or whoever, to hold down supplies, I'm thinking this is it's not a winning game. There's no way they're going to be able to collude when they're all so desperate for oil revenues. Of course, if they just shut off their taps for a month, prices would be way up.
It would still take a while to work off the inventory, and there's a question of whether they could do without any revenues at all for a month.
Gold has had a great surge in the recent time, but is it going to continue, at least for the short term?
I think the rally that we've had in gold assets this year is the real deal. Things got kind of ahead of themselves, especially in silver, which rallied percentage-wise even more than gold. So the pullback that we're having is not, it shouldn't surprise anyone. The question is, the gold bears would say that's it. We've gone as far as it's going to go, and now back into the bear market, which began in 2011 for precious metals. So, I'm looking at COMEX gold contracts. We had a big rally into mid-February, and we've been kind of consolidating ever since. And if you draw a trend line from the first move off the top through a couple of lows that occurred in February, it gives you, I think, a pretty good trend line. It allows for right now a further fall of about $38 in the price of gold. That trend line, I think, is going to be very important. If we don't pull back to that line and gold starts moving higher again, it would be very bullish. It means the trend is steepening, and that would be indicative of a really powerful bull. But for the moment, meaning the next couple of weeks, I've got the yellow flag out on gold, and we'll just see how this correction goes.
Rick, thank you very much for chatting with us.
Well, thanks for inviting me on, Jim. It's always a pleasure.
My guest has been Rick Ackerman, editor of the newsletter Rick's Picks. His website is rickackerman.com. He was speaking to us from Superior, Colorado. You're listening to HowStreet.com radio. Find us on Twitter at TalkDigitalNet. Our YouTube channel is Talk Digital Network. Questions or comments for Gary or anybody else who appears on our show can be sent to info@HowStreet.com. I'm Jim Goddard. Thanks for listening.
Comments made on HowStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com radio is a production of HowStreet Media Incorporated.